Hi, welcome back to Why Are You Paying Too Much in Taxes and What to Do About It. This is segment 3. Hi, I'm Alexander W. Elliott, and in today's episode, we're talking directly to freelancers, contractors, side hustlers, okay, and self-employed business owners, okay? All of them are self-employed business owners, but anyway. Because there's something most people don't realize, being self-employed actually gives you access to some of the most powerful tax strategies in the entire U.S. tax code. The challenge is that you have to know about them and actually use them, because nobody automatically set them up for you the way, let's say, a payroll system does for a regular employee. Okay, it doesn't happen that way. Let's break it down. First, let's talk about, my nose is itching. Let's talk about self-employment tax and why it matters when you're a W-2 employee. Your employer pays half of your Social Security and Medicare taxes, all right? When you're self-employed, you pay both halves. That's like 15.3% of your self-employed taxes on your net earnings on top of your regular income tax. That's the bad news, okay? Here's the good news. You can deduct half of that self-employment tax from your taxable income. It doesn't eliminate it, but it reduces how much income you pay taxes on. It's one of those automatic deductions that a lot of new freelancers, they miss, or business owners, they miss in their first year, or some years after that. Strategy number 1, okay, structure your business the right way. A lot of freelancers, business owners, sole proprietors, you operate as a sole proprietor and you call it a day. And for a lot of people starting out, that's fine. But as your income grows, it's worth exploring whether an S Corp or an LLC can save you money. With an S Corp, you can split your income between salaries and distributions. Only the salary portion is subject to the self-employment tax, which means significant savings at a higher income level. This is a conversation you should have with your certified tax advisor. Once your self-employment income is consistently above $40,000 or $50,000 and above a year, okay? Strategy 2, maximize your retirement contributions. This is where the self-employed has a huge advantage. A solo 401k allows you to contribute both as an employee and as an employer. As an employee, you can contribute up to $20,500 in 2025. As an employer, you can contribute 25% of your net self-employment income. Today, the combined limits for 2025 is $70,000. And that entire contribution reduces your taxable income. A SEP IRA is another excellent option. Simpler to set up. Contribution limits 25% of net employment income. Again, the cap is $70,000. If you're a high income earner and you're not maxing out on these accounts, you're leaving a massive amount of deductions on the table. Not talking about, lowering your taxes. Strategy 3, deduct all legitimate business expenses. This is where your Schedule C, which is your best friend, especially when it's saving you money. As a self-employed individual, you can deduct ordinary and necessary expenses from your gross self-employment income. All right? That includes things like your home office, your phone, your internet. If you use it for work, obviously, software subscription, professional service, advertising, marketing costs, any equipment and tools, and yes, travel and meals from 50% to 100%. Let's do a quick real world example Say you're a freelancer, graphic designer, you're earning $80,000 a year, you have a dedicated home office, that's 12% of your total square foot of your home. 12% of your rent, utilities are deductible. You drove, let's say, 3,000 miles for meetings, that's deductible. Took clients to lunch, that's deductible. You paid for an online course to learn graphic design or anything educational, okay, that's deductible. When you add all that up, you may reduce your taxable self-employment income, but let's say $15,000 to $20,000. Without doing anything extraordinary, that could save you $4,000 to $6,000 in taxes a year. Strategy number 4, make your quarterly estimated payments. I know it isn't a strategy, but in the traditional sense, it protects you from serious mistakes. You're self-employed, and you need to make your quarterly payments to the IRS. They're due April, June, September, and January. You could face underestimated tax penalties. Okay, so you need to set aside 15 to 30% of your payments to pay those estimated taxes. Okay, you want it there. You want to contribute that so you don't get paid you don't pay some additional taxes. Strategy number 5: health insurance premiums. We mentioned this in episode 2, but it bears repeating. If you're self-employed and you pay for your own health insurance, you can deduct 100% of those premiums for yourself, your spouse, and dependents. Okay, that deduction comes straight off your adjusted gross income. Okay, the overall mindset I want you to take away from this episode is this: being self-employed means you're the CFO of your financial life. You have to be proactive. You have to track your income and expenses, okay, and your estimated payments, and use every legal tool available to keep more of your earned money in your pocket, okay. Again, working with a good certified tax advisor who specializes in self-employment taxes is one of the best investments you can make. Their fees are also deductible, okay. Next up in episode 4, all right, we're going to talk about real estate. If you own property, rentals, home investment, land, there are tax advantages waiting for you that most homeowners never take advantage of, okay? Also, we just added the client library to our website under client resources. We have information on taxes, accounting, topics, articles, white papers, educational videos. And also we have a free monthly financial and tax newsletter. Be sure to sign up for that. Again, it's free. All right, my nose is itching. See you in episode 4. Take care.